understand the economy, you have to understand human nature.
This podcast is powered by Acast.
How you doing there? Time for the podcast. And today's podcast is going to be about the United Kingdom, the British economy, the British political system, but more importantly, what the recent crisis in the British gilt market, i.e. the bond market, and the weakening of sterling is telling us about the United Kingdom. And the reason I want to talk about this is that in my career as an economist, particularly many years ago, working in the City of London, what struck me was the sensitivity of the sterling exchange rate and the British gilt market to changes in British policy, in the sense that they were more sensitive to good and bad underlying movements in the UK than most other gilt markets and our currencies. So, John, that's what we're going to talk about. We're going to talk about currency crises in the UK and what I believe to be the case, that the British are going to suffer a major currency and gilt crisis either this year or certainly within the term of this Labour government.
Are they not already in that crisis? Because everything I'm reading and hearing about the UK and the UK economy is that it's banjaxed. And Rachel Reeves, rightly or wrongly, is getting blamed for everything.
Well, it's interesting you say that. Number one, I'll give you one statistic, right? The country in the European Union that is most associated with calamity, economic calamity, is Greece. When you say Greece to somebody, the alarm bells that go off in their heads are bankrupt country, can't pay their bills, defaults on their debts, highly weakened economy.
Yanis Varoufakis.
All sorts of carry-on, right? Greek long-term bond yields, so the interest rate that the Greek government has to pay in order to borrow, are today at 3.7%.
Right.
The interest rate that the British government has to pay, 4.8%.
Okay, so what's the significance of that?
So the British rates are about, give or take, 20 to 25% higher than Greek rates, which means the market perceives the risk in Britain to be substantially higher than the risk in Greece.
Okay.
Now, what is that risk? That is inflationary risk, exchange rate risk, and our default risk.
How long has that interest rate been there? Like, is this a new development?
This is a reasonably new development. So what has happened in the case of Britain is the long-term interest rate has been going up and up and up as the risk in the British economy has been getting more and more significant. Right? So that's the first thing. Greece, the reason I picked Greece is because Greece is an outlier on the downside, or should be an outlier on the downside in the context of the European Union, because as I said, it has become a byword for economic malfeasance, malpractice, and default. So maybe the Brits should start by giving back the Elgin marbles straight away, right? Just give them back, okay?
Have you ever seen them?
No, of course I haven't. I'd like to see them.
They're fantastic.
They're obviously Greek.
Yeah, they're
right?
Fantastic. But yes, I agree.
So that's the first thing. But the second thing I want to talk to you about, John, we're going to go and talk to a young Irish economist called Philip Pilkington about the British economy in a moment. But I want to focus this podcast on great currency crises in the UK in the past, right? There has been a relationship between the Labour Party and currency crises going back to the 1930s. So Ramsay MacDonald, John.
Hey,
Ramsay MacDonald may or may not be a name you're familiar with, but he was a British finance minister, a Labour finance minister, who took, or as they call him, a chancellor, who took, in 1931, the Brits off the gold standard.
Right.
Okay. Then we look at 1968, Harold Wilson, another Labour.
Sorry, and when he did that cause a crisis then, or did he take it off because of a crisis?
He took Britain off the gold standard because of a crisis. In fact, most British economic history in the 1920s centred around the gold standard and whether they should go back on the gold standard. Winston Churchill was a massive supporter of that, who was also the Chancellor, Tory Chancellor, or whether they should come off the gold standard. But the reason they came off the gold standard is that nobody thought that sterling was as good as gold.
Right.
So get that in the back of your head, right? 1968, Harold Wilson devalues the pound for the first time in decades. Again, a Labour Party government, Labour
Right.
Party. And again, 1976, Jim Callaghan, Labour Party, invites in the IMF. Remember, we had the IMF Troika.
Yeah.
Britain had the IMF 30 years before us.
Really? I didn't know
So
that.
they had an IMF bailout in the 1970s. They couldn't pay
Right.
their bills. They had the winter of discontent. This all set up the scene for Margaret Thatcher.
I remember that phrase, the winter of discontent, but that followed on from the oil crisis of 74. Was that the cause of that?
That was the cause of that, Britain's inability to respond to that, all that stuff. But what I'm saying is currency and gilt crises and the Labour Party government are old friends, right?
Yeah.
And we're seeing this again. But it's not just the Labour Party government. In fact, I remember my first real experience as a monetary economist was the 1992 sterling crisis, which was under John Major's government,
Yeah.
which was obviously a
Yeah.
Tory government. And I want to tell you the story. There's a certain beautiful irony going on at the moment, right? Particularly this week. The summer of 1992, in an office in London, there is an American lawyer. And this American lawyer is working on a blueprint or a framework for the destruction of sterling. This American lawyer is battling with his own demons at the time. He didn't want to come out as gay. So that was his own moral dilemma that he had.
Who was he?
His name, he was a very young man at the time. His name was Scott Bessent.
Right.
Scott Bessent was, on Monday, crowned as Donald Trump's Treasury Secretary.
That's where I know the name.
Now, here is the story of Scott Bessent is a beautifully interesting story about sterling. So Scott Bessent worked for George Soros. Fascinatingly, now Scott Bessent works for the guy who thinks George Soros is the Antichrist. Because
Yes.
George Soros, right?
Yeah.
So Scott Bessent worked for George Soros, and Soros was in the United States in 1992, but he got his London office to work on the blueprint for his plan to break the Bank of England.
Can I just ask you, why did he want to do that?
So Bessent was a lawyer, and it's quite interesting. In a lot of these hedge funds, lawyers, not economists, have a very significant position, right? Something I've noticed. So it was a guy called Stanley Druckenmiller, Scott Bessent, and George Soros came up with the plan.
Right.
So the plan was that the British could not maintain a currency target against the Germans. They decided the Brits would devalue, and they would precipitate the devaluation by speculating against sterling. And if they were to get that devaluation, they would make a fortune.
But why, Mac?
Good question. A, to make money, but the secondly, why did they think Britain was particularly weak in 1992 was the following. You were in London in the late 80s. They had a massive, massive property boom
That's right, yeah.
under Thatcher and Nigel Lawson. That property boom went bust in the 1990s, the early 1990s,
Yeah.
as they had to increase interest rates. Why did they have to increase interest rates? Because the current account deficit had got so out of control in the United Kingdom. This is their ability to borrow in order to cover their day-to-day expenses.
Yeah,
Right?
I remember that because my brother included, but most of England went into negative equity then.
Exactly. So
Yeah.
keep that thought, right? So also they went to negative equity, but at the same time, inflation was rising in the United Kingdom. So they decided, okay, how do we get inflation down? What we will do is we will tie our currency to the German mark, because the German mark was the strongest currency in Europe.
Yeah.
And by doing that, we will increase the value of sterling. That will then bear down on inflation here, and we will get the benefit of lower German interest rates.
Right.
So that was the general idea. And we would do this and everything would be hunky-dory. What nobody really figured out, or at least expected, was German unification came very, very quickly. And the Germans, uncharacteristically, decided to borrow to cover the cost of unification.
Okay.
As the Germans continued to borrow, the rate of interest went up, because the rate of interest is the price of borrowing. And if one crowd is borrowing a lot, the price goes up. So basically what happened was the rate of interest went up. That meant the rate of interest in England started to go up.
Right.
Now you exactly mentioned your brother,
Yeah.
who was in negative equity. The way you get out of negative equity is you create positive equity. The way you create positive equity is you reduce interest rates so that house prices begin to rise,
Yeah,
which rebalances the balance sheet of people like your brother that were broken. But if you have got a policy that is committed to tying yourself to the German mark, it means that you have to, by default, accept German interest rates as being the floor of European interest rates. And as German interest rates rise, you, as a Brit, can either have a currency that's stuck to Germany or low interest rates, but you can't have both.
Right. Okay.
So Thatcher and Major decided, okay, we prefer low interest rates, but we can't have low interest rates and be as strong as the Deutschmark.
Was this Black Monday?
Yeah, exactly. So something has to go.
Yeah.
So Scott Bessent an American, is sitting in an office figuring out, okay, how do we speculate against the Brits? How do we call their bluff? Now, what they had to do is they had to borrow a huge amount of sterling forward. So they had to borrow sterling to pay back at some stage in the future and hope that the currency would fall in value so that when they came to pay back the money, they'd have to pay back less. Okay?
How much are you talking about here?
Well, they made $1 billion. So
They made $1 billion.
They made $1 billion in one trade.
$1 billion?
$1 billion they made in one afternoon.
Wow.
So in order to do that, you can't just do that overnight. You have to enter into a whole series of forward deals, a whole series of transactions, so that over time you build up this, what is in effect a negative position in sterling. So over time, they had to borrow and borrow and borrow huge amounts of sterling with the promise to pay back that money in 6 or 12 months' time. Now, had the British not devalued, Soros would have gone bust. So it was a existential, career-defining bet.
Wow.
Okay?
Yeah.
And Bessent was the guy who put it together.
Sorry, who did they borrow it from?
So they borrowed from loads and loads of other banks. So they would have gone to the bank, let's say they'd have gone to, I don't know if this was the case, let's say they went to Goldman Sachs and they said, we'd like to borrow 100 million sterling from you.
And this is our plan.
And no, they didn't tell them what the plan was.
Right.
We'll tell you 100 million sterling from you and we will pay you back in 6 months' time, right? Now, of course, a counterpart would say, well, what do you need the money for?
Yeah.
And then very quick, the penny would drop that these guys were betting against sterling. So in order to bet against sterling, you had to have on the other side of the trade people who wanted to bet for sterling, in favor of sterling.
Okay.
So in order for you to facilitate me borrowing 100 million in sterling, you had to be pretty confident that the value of sterling wouldn't fall. In the same way as I had to be pretty confident that the value of sterling would fall.
And that's the English Central Bank.
So you have two major players here.
Right.
You have the Bank of England on one side, and it's always very dangerous to bet against a central bank. Why? It's the central bank prints the money.
Yes.
Okay.
Yeah.
And then you had all the City of London blue blood British banks that were kind of lent on by the Bank of England in a moment of natural patriotism to support the Bank of England. Now, so what would have happened in those trades as Bessent was putting them together methodically over months and months and months, lots of those British banks would have gone to the Bank of England and said, you know, these Americans, they're speculating against us. And the Bank of England would have said, don't worry, we'll crush them. We will crush them. But a fascinating thing about currency crises is that what starts small can gain momentum very, very quickly.
Yeah.
This is the blood in the water notion, right? When the shark sees the blood in the water, all the sharks come in, right? So it is with a delicious irony that the man who broke the Bank of England in 1992, precipitating the crash in sterling on Black Wednesday, which is in October of 1992, is now the very Treasury Secretary in situ in the United States when the Brits are having yet another currency crisis.
Yeah.
And just to add spice to this dish, John, The reason in 1992 the Brits had a crisis was German interest rates were rising.
Mm-hmm.
The reason the British are having a crisis now is not only is their economy badly managed, but the background noise is American interest rates are rising. So the floor on global interest rates is American and they are rising under Scott Bessent.
Yeah.
Back then, the floor on European interest rates were the Germans, which were rising. But fascinatingly, a young man who put together the strategy to destroy the Bank of England back then is today the man who is in charge of the dollar. And the sterling dollar rate is as low as it has been for many, many years. And it is falling. So at the height, for example, of the Tony Blair government, 2007, you could get $2 for every pound sterling.
Yes, I remember that, yeah.
You can now get $1.22. So it's almost halved.
So should we put a plan together to bet against sterling now?
Well, you know what we should do?
Pick up the phone there and ring some of your buddies.
Yeah. Well, it's actually a very, very good... If you have a plan...
I do, yeah.
...to buy something in the UK, an asset in the UK, just hold off because they'll be much, much cheaper once the currency stroke gilt market implodes over the course. Now, what may well happen, and this is the crazy thing, is that a British gilt stroke sterling crisis in the next 12, 18 months or in the lifetime of this government will lead to a UK Troika style program where the IMF are called in to bail them out. That sounds quite outlandish, but it's happened before. And my sense is we're going into, as I said, we talked about the bubble last week. I think we're going into a very, very jittery time in markets, a very, very volatile time in markets. And I think the UK could well be in the crosshair now of all sorts of speculators over the course of the next couple of months. But in order to get a handle on this...
That's not good, though. It's just not good. It's not good for us.
It's not good for anyone.
Yeah.
But, you know, good isn't what economics is about.
Yeah,
it's not
that's
about,
the problem with economics.
No, but like finance isn't about good or bad. It's about, you know, I think we said in the last podcast, macroeconomics puts manners on people, right? In the sense that it is a bullshit detector for bullshitters. In the sense that if you are trying to get away with inconsistent policies, you will eventually get found out by the harsh glare of macroeconomics. In order to get a handle on just what's going on in the UK, to allow us arrive at this conclusion, John, let's go and talk to Philip Pilkington, young Irish economist who's been writing about this, has got a very good handle. Will talk to us about productivity, will talk to us about regional inequality, big bets in the UK, how they got to where they are. So let's go to London and talk to Philip now. Yeah.
And actually, just before we do, I do need to apologise for the quality of the line. We're on one hand at the behest of the internet, but I've cleaned it up as much as possible. So forgive me.
Forgive him. Something that economics would never do. It's no forgiveness, John.
Yes.
It's the rapture. It's either redemption or failure and nothing else. All right, let's go to London. Talk to Philip. Philip, how are you? Great to see you. How are you doing?
Thanks for having me, David. I'm doing very well.
Wonderful. Now, the UK in the last 4 or 5 weeks has had what you would call a slow creeping run on its gilt market. And by that, I mean that every day people are saying, not too sure about this, not too sure will I lend to this country. Sterling has been battered to the extent that anybody's been battered at the moment. The gilt market is down. And there's a general sense that the UK may well be going into a period where people are questioning the very solvency of the country. Now, I'm talking as an Irish person who's lived through 3 serious solvency crises in the country. So countries can go bust. We went bust in 2008, we went bust in the 80s, and we almost went bust twice in the 80s. So it can happen, right? Tell me, Phil, what are you thinking when you look at the UK and the long-term sustainability of the UK as a business model?
Well, I'm thinking, looking at the events this week, that I'm not very surprised by it. I'm not currently in the UK, but I was in the UK less than a year ago. I was living there. And, I had friends. I worked in financial services for years, investment management. And so I had a lot of friends in the city and so on. And it was kind of well known. Probably 2 years ago, 2.5 years ago, I was hearing from hedge fund managers, especially in Green Park, that the gilt market, the foreign gilt market, the domestic gilt market is a separate issue. The foreign gilt market had been trading like, quote, an EM market for at least 2.5 years. And basically, what that means is that very little liquidity, that in order to buy something, with a perfectly liquid market, you can just bid a little bit ahead of the thing, or, if anyone uses trading platforms, they probably know this. In a highly illiquid market, the price could be at, 100 one day, and you want to buy it at 100, and you bid, and like you buy it at 120 or something like that, rather than 100 plus one
Yes.
penny or something like that. And when you see a market trading like that, it's a market with problems. So the short-term problem with the gilt market's been there for a while, and that also goes back to, by the way, the crisis around Liz Truss and so on. It's part of the same thing, really.
Well, can I just stop you there? So EM markets, just to explain to listeners who mightn't be au fait with this, is emerging markets, right? Now, the emerging markets are countries which tend to be typically poor, underdeveloped, and more importantly, I think, Philip, it's fair to say, rely on foreign capital to sustain themselves. So in the extremists, we're talking Argentina. In closer to home, those markets would have been the markets of Central Europe. Even during the crisis in the euro, Portugal, to a degree, Ireland, Greece, etc., where you're dependent on foreign capital. So you're saying the UK, far from being a developed market, is trading a little bit like an emerging market.
And has been for some time. I can say at least I was hearing this 2.5 years ago. It may be more, it may be 3, maybe 4, I don't know. The Bank of England don't publicize this. You can imagine why. I think the best way for people who aren't familiar with the ins and outs of foreign bond markets to think of it is that in a functioning bond market, in a developed market, functioning bond market, and, emerging economies can have perfectly decent bond markets. Some emerging
Absolutely.
economies run big trade surpluses. So I don't want to tar it with that brush, but that's just the language that was used to me. In a functioning bond market, you kind of just issue the bonds and your primary and secondary markets just take care of it. When you're in a choppy market, you kind of have to go out and beg. Now, that's greater or lesser. I work peripherally doing analysis on the Argentinian bond sales under the Macri government. And for example, the Macri government would actually have investors, large investors, not small investors, but large investors over, and they'd wine and dine them and give them Argentinian steak and Argentinian Malbec and all that kind of thing. And they'd be like, please buy some of this debt. Now, that's an extreme example. Argentina is one of the most crisis-ridden economies in the world, as I'm sure people know. But I think it gives some sense. Yeah, there's a very big difference between being in a position like that and being in a position where your entire bond market system is effectively automated. Britain is somewhere in between on that, from what I can tell.
But it's interesting you mentioned Argentina, because John might remember about 4 years ago on the podcast, maybe even 5 years ago, a long, long time ago, just after our friend Boris Johnson was elected. And I described him as an Eton Peronist. And I also said there is a chance that Britain becomes Argentina. And by that I meant that good countries become bad. This is my point. It wasn't that it goes blow by blow, exactly like the Argentinian playbook, but countries that were once very rich can become very dysfunctional, very, very badly run, very badly managed, and can find themselves quite quickly in a hole whereby the rest of the world doesn't believe them. Now, let us explore the possibility that something like this could happen to our closest neighbor. Let's look at the economics, the underlying. It's not just that Elon Musk doesn't like Keir Starmer. It's not just that the MAGA people have turned against the UK. It's not just Brexit, but it's lots and lots of other factors.
No, that's exactly true. Look, this has been a long time coming. I know you worked in the city as well at one point, and you'll know, because I do, that increasingly and over time, this has got more so, the British economy has become more and more focused on financial services, and it's gutted its manufacturing sector. It's effectively a form of Dutch disease. I don't know if listeners know about that. That's usually when a country finds large amounts of energy reserves, oil or something like that. They're living high on the hog. and the rest of their economy just gets gutted out. The City of London has sort of done this to Britain, and it's been doing it probably since the Big Bang under Thatcher, but it really, really sped up under Blair. And I think everything felt really good, even though it was, a lot of the country was going downhill. And then they hit 2008. They put the regulations in place that they have to do because the system had blown up, and productivity growth just flatlined. Real wage growth flatlined at that point. I don't think people are aware, but since 2008, there's been no real wage growth in Britain. That's not the case in most economies. I mean, you have to go to Greece to find that. Ireland's had real wage growth, France has had real wage growth, Spain, Portugal, everyone's had real wage growth except Britain. And it's just lack of productivity. And it's due to the fact that this financial services Dutch disease has finally taken its toll. So I think this was a long time coming. I'm not saying that doesn't mean that the country is a lot poorer managed than it was in the past. I do get that sense too.
Okay, so let's explore this. So the elixir of all economics is productivity, which is basically how much stuff you put in and how much stuff you get out. And hopefully you put less in than what you get out, right? And then of course that can be measured. Again, listeners, if you're new to the economics game, that can be measured in terms of one factor, i.e. labor, or how much labor is producing, or capital, which is, how much, as the Americans say, how big a bang are you getting for your buck, or usually and more sophisticatedly, what's called total factor productivity. You combine them all together and you see what's happening. So what you're saying is at that very basic level, the UK is stuttering.
It has been since 2008. And it's actually, they say it's a big mystery there. Look, productivity declines are happening all over the world. They happened later than in Britain, I'll just highlight. And that's kind of a big mystery that people are debating or whatever. But in Britain, I don't think it's a mystery at all. I think it's very simple. They increasingly relied on financial services for their economy. First of all, it's not clear what productivity growth in financial services means, just putting that out.
Yeah, but there's no big technological revolution that's going to happen in financial services, which is going to change the way in which it does business. So you're saying you bet on a low productivity business that for a while does very, very well, sucks in all the resources, all the talent, all the money of the country. The rest of the country is left flailing in its wake. And then suddenly that massive bet goes bad precisely because the sector runs out of road.
Yes, but here's where the other aspect, the macroeconomic component of the model comes in. We're talking about the productivity and the real impact it's having on the economy. The macroeconomic impact that it has is the really unsustainable part, because what it allows the country to do is run giant trade deficits. And the trade deficits now have been truly giant for a very, very long time.
Give me a sense of that, because I haven't looked at the figures in the UK.
They're about 4 to 5% of GDP. I think they peaked out one quarter above 6% of GDP. Now, that may not mean something to somebody who doesn't look at these statistics all day. Again, we're back in kind of failed EM state territory there. That's usually what happens, like with the Asian tiger bubble, where they were pulling in all this capital. It was allowing them to just consume all these products that they couldn't really afford. Britain's doing that. Now, look, America runs large trade deficits too, but America, at least for now, has the world reserve currency. And so we know why that is. Britain is not the reserve currency. It's sort of piggybacking on the hegemony of the US dollar, but it's not doing so in the same way, because the US dollar, all they have to do is the Chinese have to just say, well, we want to keep our reserves in US dollars. So they accumulate these big stocks of US dollars. Occasionally they recycle them into the other assets, mainly US Treasury bills or something like that. The UK kind of has to sell itself. It has to actually say capital inflows should come into the City of London. You don't really want to hold sterling in reserve. It's not a good reserve currency. It constantly falls in value over time if you look historically. So what you're really doing is you're going out into the world and saying, send us stuff in return for British sterling-based financial assets. That's an extremely unstable model, and I feel that's what's kind of going awry right now.
Okay, because I like this kind of image of Britain sort of pimping herself out to anybody who will buy any bit of Britain in the vague hope that that money can then be used to buy Mercedes and to buy foreign stuff that they don't make, but they quite like having. So you're living, again, this is a classic case of a standard of living which is rented, not earned. And once it's rented, basically the landlord or the creditor dictates not just the price, but the quantity of money you get. Can you paint a picture, Philip, for me, let's say over the course of the next 12, 24 months, that may well lead to the UK? At the moment, it's a skirmish in the gilt market, and it's very much where people like us discuss, and people who might read the Financial Times, et cetera, et cetera. How does this go bad for the average person?
That's the nightmare scenario. You see, they do a lot of bait and switch in Whitehall about what the real problem is. And there's a reason for this. So what the Whitehall people do, and I'm talking about the Bank of England and the Office for Budget Responsibility, those are the two key entities there. And basically, they try and make it out that this is all about overborrowing by the government. And the government has massively borrowed in the past few years. There's absolutely no doubt about this. But the issue is the foreign borrowing. And it's what we were just talking about there. So what everyone's being told in Britain is this crisis has to do with overborrowing by the government. And it's not quite. It's actually overborrowing by the foreign sector, as we're saying. Now, they're not doing that for nefarious reasons. It's the only lever they can pull on. They can't really pull on the capital account. They can't really pull on, demand for sterling. So all they can try and do is get their fiscal house in order. But that's kind of a confidence job. What you're really doing there is you're just selling the fact that you should continue to invest in Britain Ltd to the international market. So that is all going awry now because the domestic borrowing is completely out of control. The economy is so dysfunctional now at this point, it's kind of unbelievable. And the foreign markets are starting to switch up. And this is before we talk about this spat between them and the Americans, which could not come at a worse time, frankly, because if the Americans don't back Britain Ltd ceases to exist in an even more profound way than what would happen if America stopped backing Ireland Ltd, for example, because it's much more fragile. So I think that's pretty much what this looks like. You see a crisis, it'll be framed as a bond crisis if it occurs or when it occurs. But what'll really happen, and the real variable to watch, will be watch the pound sterling adjust. And by the way, this has happened twice before. Pound sterling adjusted once after the collapse of Northern Rock. I think it fell by about 20%. And it adjusted a second time after the vote for Brexit went through. I think it was, again, an adjustment of 20%. The market sets the rate for sterling, and it can set it overnight if it likes.
Well, I have very personal experience with this. I was talking about it at the top of the show, and I'll talk about it again with John after we digest what you've said, Philip, which is the 1992 crisis, which was a classic sterling confidence crisis where the currency just dropped like a stone in the way in which it doesn't happen in other European countries, in the way in which the Eurozone was set up to prevent this sort of stuff happening. Why? Because they realized this is the sort of thing that sparks anxiety in the people. When the value of the pound in your pocket, to quote Harold Wilson, actually degrades, you get not just a crisis of financial confidence, but you get a crisis of real confidence. So, Philip, if you were a betting man, I've been watching the last couple of weeks, and I've been watching the way in which the Bank of England is fighting, in effect, a rearguard action to try and prop everything up by intervening, by doing what central banks do in a crisis. I've also been looking at the messaging coming out from Whitehall. I've been looking at the messaging coming out from the cabinet. I've been looking at what looks to me like, as you would describe, a bunch of reasonably well-informed individuals who are trying to pretend that this is not happening. Now, that can last for a while. How does this play out? Do you have a sense of timing? Do you have a sense of urgency? Do you have a sense of imminence? Or do you think the UK can kind of stumble on for a while?
I think it may be able to stumble on for a while if the government manage it properly. I think what will probably happen now is that the men in grey suits will sit down with their briefcases with the Chancellor, which is Rachel Reeves, who, by the way, is already being tipped to be thrown out by the summer, apparently. And she will be told, all sorts of scare stories, most of them probably true. And they'll basically say you have to come up and give a massive confidence boost to markets. And what that'll probably mean is doing tax increases against the Labour pledge, right? But I don't think that they can get the fiscal situation in the United Kingdom under control unless they've some trick that they can pull out of the bag that's insane. I mean, what ultimately will probably happen here is I don't think the whole thing's going to collapse this week. It could, but if I were a betting man, as you say, I'd say probably not. They'll probably step in, do some tax increases and so on, shore up confidence. Then we'll move to another crisis. And then eventually where it ends up is one of two things. You could get a genuine sterling crisis, and that is a possibility.
Oh,
And
yeah.
actually, what I think adds massively to that is the dust up with the Americans. If the Americans really go heavy with Britain, it could get out of control. I think the more likely outcome of that is that the Whitehall institutions eventually find themselves at the end of the rope, and they say, "Okay, we are really staring off the cliff here," and they go to the IMF. I think that's probably what would happen. And then what will happen is you'll have a new troika, and it'll be Treasury. Well, it'll be the quadruple, whatever it is, the quad
Quadtroika.
version of
Yeah.
the
It's
troika.
actually, I know, it's called a chetvert in Russia. If you take
Okay.
troika.
Right.
There you go, John. Did you know, a man who knows what a quarter is in Russian. Okay, a chetvert.
You won the podcast. Congratulations, Dave. They'll have the Bank of England, the OBR, the Treasury, and the IMF. That's my bet. And then, as we know with the experience in Ireland, that thing, that like Martian entity will come in and just completely take over the government and tell everyone exactly what to do. But here's the one difference. I pointed it out in the thread. If that happens, and that's, I think, what will end up happening, by hook or by crook, I don't know how long it'll take, the type of austerity that'll be imposed will not be like Ireland. Ireland's was a temporary austerity to get unit labor costs down, to get wages down relative to productivity. We're back to that again. And then Ireland kind of bounced back. Exports bounced back. The economy, pretty much stabilized. And living standards, lo and behold, they're probably higher today, nominally anyway, than they were before the austerity. That is not the future that Britain faces. The underlying structural problems, because Ireland had a real manufacturing economy where you could drive the wages down, be competitive. Britain, as we've discussed, has a kind of failing financial sector. It's been living beyond its means for too long, and that means a permanent adjustment in living standards. Because the model isn't Ireland in austerity, the model is Greece in austerity. And I know that sounds horrendous, but I mean, it seems true to me.
Greece is a 10 or 15-year process of significant emigration, profound fall in living standards, in real wages, and various governments and iterations of governments that go through these crises, all of which would suggest that the UK, with Farage rating in the wings, with Reform rating in the wings, looks very different in 4 or 5 years' time.
Yeah. I mean, it's already unstable politically. Labour were supposed to get in and stabilize the situation politically. Okay, how did that work out? So it's already destabilizing politically, even before they've hit the real part of the crisis. It's awful. I feel really bad. I lived there for most of my adult life. I really like Britain, but they've been living beyond their means for a very, very long time, as had Greece.
On the Greek analogy, it's time to give back the Elgin marbles, clearly. Yeah. Anyway, Philip, great stuff, Philip. Wonderful to talk to you.
Thanks a lot, David. Thanks for having me.
Yes, a terrible line. Again, I'm really sorry, but really interesting stuff from Philip there. But here's the thing, that Rachel Reeves is getting kicked around the place now, and some say that she's going to be gone very soon as Chancellor. Who knows? But who would take over, first of all, in the Labour Party? And secondly, even if it wasn't the Labour Party, they inherited this state of the economy from the Tories. I mean, if Reform got in, for instance, how would they fix it?
You don't fix things like this. You have a crisis. The crisis leads to austerity. The austerity, as Philip says, and I think he's right, we were kind of joking about Greece at the top, but I think the UK ends up looking much more like Greece in terms of a long-term dilemma and problem. I think one of the problems is very much what you've just identified in the UK, which is associating social, economic, financial and industrial failure with one person, the party machine. I think so Rachel Reeves carries the can in effect. And that in a way is a function of, I think, the British media establishment, which is highly, highly political, and they're always pointing fingers at one another. This is, as you've pointed out, or you kind of suggested, John, a generational issue. It's going to take a whole generation to begin to fix what is a problem for a very large country of 70 plus million people. So it's a very, very large country. And it needs a massive rethink about regional policy. And when I say regional policy, I mean the regions in the UK.
Yeah.
That's the first thing. It needs a massive increase in education policy. It needs a complete decentralization of the system.
Yes. Well, that was what Philip was saying, that,
It's highly centralized. The UK is run, ironic for a country that has delivered Tory governments for most governments since the Second World War. It is run like a socialist country. Highly centralized, highly dirigiste, as the French would say, top down. And ultimately, it's a country that needs to reinvent what it is. What does Britain do for a living? Now, it can be done, and I think it will be done. And I think a crisis may well be what they need, because then you can actually galvanize the resources of the country. But I think Philip's point is very well made. And I think if you remember back, we did a very interesting podcast about 2 or 3 years ago with a very brilliant economist called Robert Lind, who worked with me at UBS, Phillips and Drew years ago, right? Great economist. And he was making the point that that big bet on financial services that was made in the late 80s, early 80s into the late 80s, early 90s, that bet allowed Britain to carry itself over a period where maybe it shouldn't have been allowed. And by that, I mean it generated such a huge tax surplus that those taxes could be used to ameliorate the provinces and in some way cement over the cracks in the regions, the north versus south, all that sort of stuff, right? But that bet on financial services is now coming to an end. And they need to get another trick. Britain needs to figure out another trick.
Yeah.
It will do so.
Well, it's going back to what you said on a podcast a few weeks ago about diversity and the lack of diversity in the UK because they put all their eggs in one basket in the financial services
market. And also, you think that Britain used to have a very, very big chemical industry, very, very big pharmaceutical industry. This is over and above what we know about the coal industry and the steel industry and car and all that sort of stuff. When you bet on services, you begin to put yourself into the position where you get mugged by productivity. And by that, I mean services by definition are low productivity. And so they're a volume game. And so as long as volumes were great in the UK and they were basically, the UK was becoming the money laundering capital of Europe, right?
Yeah, very much is.
Well, what I'm saying is maybe not money laundering, it's too extreme, maybe money washing, right?
Yeah.
So European money comes in, it gets turned around, right? That game is kind of over now. And of course, Brexit accelerated the end of that game because the Europeans are saying, well, if you don't want to be European, you can't have our money.
But when you say that, with the IMF possibly coming in, that...
But who else is going to lend to Britain?
Sure, yeah. But that this could also be almost like the end of the Democrat Party. This could be the end of the Labour Party.
It could well be.
If they're kind of, people point the fingers at them and said, it's all happened under your watch.
Well, that'll definitely be the play that the Reform Party will want.
Yeah.
But the Reform Party, remember, are trying to basically eat the lunch of the Tories, not Labour.
Yeah.
So the people who would actually move to Farage, I mean, the upshot of all of this could well be Britain, gilt crisis, sterling crisis, IMF, bailout. As I said, it wasn't going to be a troika, it'd be a Chetford. Remember I was using that word? A government run by Nigel Farage. You might smirk now. Just put it in there. It's an outlandish idea. Just put it in the box and we'll see that we come back to it. A Farage-led government after this Labour government. Think about that. Reform, how are you?